and okay, and we've got Elizabeth who's saying hi from Sampson Realty. Elizabeth, I'm going to cut and paste your message so that everybody can see your intro. So if you guys see this now, that is using that all panelists and attendees dropdown. So interact with the other attendees. And then today we're going to be talking about reverse mortgages. So I know you're going to have a lot of questions. So you can type in your questions into the Q&A box, but then you can also raise your virtual hand and we'll call on you and we can answer your questions that way. So that's a little bit of the housekeeping. So now I want to thank the Elite Collection by Watermark and Silverstone for their sponsorship this June. And I'm really excited to be here at the Landing Sales Center. This is the first time that we've done one of these remote, but the Landing is, and I've got Kitty Janney, the Director of Marketing, but I don't know if you guys can see this. This is a rendering of the Landing. It's going to be absolutely beautiful in the Potomac Yard section of Alexandria, pretty close to where we are right now in the sales center. But Kitty, tell us a little bit about this project. When is it going to open? What is it all about?
Well, thanks for being here with me today, Steve. We are opening early next year, so probably February. We'll have 40 independent living apartments. We'll have assisted living and memory care. We hope that our residents will age in place with us. And we've already taken some deposits, so really exciting.
Great. And I don't know if you all can see this, but behind us, you can see the finishes of what is going to be in the lobby of the building. And like I said, the rendering is absolutely beautiful. When do they start digging the hole?
It's done. The building is up. It's 9 stories. And they just are completing it. So it's wrapped in purple. If you drive by, it's right on Route 1.
Okay.
And they're starting on the inside. So it's exciting.
Oh, holy cow. Okay. So how long do you think it's going to be before the sales center can move over to that location?
I would say probably November.
Okay. All right. So we still got a fair amount of time.
We still have the whole inside to do.
Yeah, this is not easy putting together, especially these luxury buildings. So this is really exciting, Kitty. I want to thank you and your colleagues at the Seneca, which is in Rockville, and the Providence, which is in Fairfax. And so this is sort of my practice session because next Tuesday, I'm going to do a remote from the Seneca. And hopefully by the time I make my way to the Providence, I'll have all the technical issues worked out. So thanks, Kitty. And now what I would love to do is welcome Bill Hornbeck, our presenter today. There you are, Bill.
Hey, good.
Great.
Good day. Hello, everybody.
So Bill, I am delighted to share with our audience the interesting, confusing, and important topic of reverse mortgages. And I've known you for a long time, and I know that you're really good at explaining reverse mortgages. But before we dive into that, tell us a little bit about yourself and what led you to this career path.
Oh, good. Well, interestingly, while I've been in this business about 14 years, I actually spent 28 years as a technologist, as a technology startup CEO. I was what you commonly refer to as a serial entrepreneur. Couple minor successes, a couple major losses, you know, that type of thing. You get through it. But interestingly, when I decided to move on back in 2008, I was really looking for a future where I could really make an impact that I felt was right on for my character, if you will. And I had been analyzing what was going on with the aging of America. Now, I'm a baby boomer, I'm a child, a flower child, and I recognized at that time that people, especially the flower children of my era, knew that the future was going to be perfect and it would certainly take care of itself, right? And of course, that is not what happened. And as we got closer to realizing that there were issues in being able to manage the affairs of state, if you will, in an elder age, I found that the opportunity to utilize a tool as powerful as the reverse mortgage is, in which people will learn about more today, was a way for me to contribute to society, if you will, have a quality of life, wake up every day with a smile on my face, you know. That's what brought me here.
I love it.
Today.
Oh man, what a great story. And I have to, I hope I'm not putting you on the spot, but I love your accent. It is like, it's just this slight Southern drawl. I've always been enamored by that. Where are you from? Where did you
Wow.
get that accent from?
Hey, I don't have an accent. Hey, look, it's an interesting question. A combination of things. Number one, yes, I am a born native West Virginia guy. Grew up in a small town called Buchanan in the central part of the state, home of West Virginia Wesleyan College. But that's probably a little bit ingrained. But I left there, you know, as a 20-year-old, so it's not like I spent my years.
No, it's really subtle, man. It's like a movie star accent. So
great, thank you for
awesome.
that. I should say that I did marry a woman from Southern Virginia whose mother was from Georgia. So, you know, you kind of pick up that.
Oh yeah, no, listen, you stay in France for 2 weeks and you start speaking with a French accent too. So okay, well, this is exciting, but you know, let's dive into this topic. And what I want to remind our audience is that you can ask questions. You just type them in to Q&A and we will make sure to address them. We actually did get a few questions via email that I'll read to you here in a bit. But Bill, if you want to share your screen, I will drop behind the curtain and we'll get this started.
All right, wonderful, wonderful. Hey, I've really been looking forward to this. So all of you who are here on this Zoominar, as I call them, I know are going to learn something really new. This is an exciting product. It's the most misunderstood product in the financial industry. I know that. There's a lot of misconceptions. Anything that anyone can say negative about the product is in of itself false. So those are all these misconceptions that I want to straighten out with you today and give you that opportunity to ask questions along the way, anything you want, and I will respond to that as best I can. So let's get on with this thing and let me get you involved in what's happening. So let's see, here we go. Who do we serve? Look, there are all types of areas of concern as we age. In this case, of course, we've got those people who maybe are going through a little process of having income insecurity in their elder years. There are those, just like the young grandparents here, who maybe just want to delay Social Security by using home equity. Maybe they want to protect against downfalls in the market, in the stock market. Use equity instead of selling your stocks, right? Or another way to let investments grow. And of course, one of the things that we all are dedicated to is the awareness, understanding, and care for the elder and their healthcare issues relating to in-home care, in which frankly, over 90% of my business is funding the costs of elder home care. But you know, it's interesting to note that actually, while you do have to be 62 to enter into this program, 62 is not that old anymore. And I was reflecting on that recently. I'm driving somewhere and I was thinking about my own age. And I came to this realization, I know you're going to appreciate this, that I realized I was getting old because I actually knew the people that the buildings and the schools and the parks and the highways are named after. So think about that where you are. At any rate, look, the point is that we come to an age in which we can use assistance, and that's one thing that this program can bring. Because in reality, if a retirement income is not available, if the Social Security is insufficient, if the savings and investments did not succeed, then what are a retiree's options? And I want to focus on those today so you can really get an example of where this might play with the people you know and the clients you have. So let me phrase that in this way. If you could live in your home forever, right? If you could refinance your home, pay off the existing lender, generate a line of credit of $50,000, $100,000, $200,000 or more, and never have to make a monthly mortgage payment. And in any event, you'd never have to repay the loan until you sold the property and keep the profit, of course. If you moved away and weren't living there anymore, or if you died, would you do that? Is that something that you might consider at any age, right? So that's the focus of what we're talking about. We actually are talking about that which is officially known as the home equity conversion mortgage. We call it a HECM, a HECM, which is the acronym, just like a regular bank's home equity line of credit, you call a HELOC. But the main difference is that the reverse mortgage line of credit, the HECM line of credit, can never be canceled, can never be paused, can never be modified. And if you remember back in 2008, when over the course of the 2000s, before the crash, banks were promoting the fact that you should have a home equity line of credit to be protected against a rainy day. Well, at that time, it was raining like crazy. And what did the banks do? They canceled the lines of credit because the home's value is reduced. This cannot happen, number one. But when we're looking at the HECM, as I call the HECM triangle, these are the components. It's not just the reverse mortgage. We're going to talk about each of these as we go through the presentation. But understand that the reverse mortgage is where we drip equity into monthly income. The asset management portion is when we actually use home equity to offset the pain of withdrawing too much from your retirement investment portfolio. Obviously, the use of home equity to fund elder health care in the home, and also the ability to purchase a new home in retirement, to downsize, if you will, and use a lot less money. So those are the issues that we want to talk about today. And let me just cover this concept here and then move into some questions as we move along, because it's a concept loan, and you have to get this. The reverse mortgage is just one part of the HECM triangle, right? So the reverse mortgage was actually created in 1988, signed into law by President Ronald Reagan at the time. So for 33 years, this product has evolved through the market, such that now, at the time, it was to help elders age in place in the home. Because let's face it, maybe the first choice is and should be to sell the home. But then as you're in an aging environment, the first thing you have to ask, you walk away from a sale and you've got money in your hands, well, where are you going to go? And how long will the money last? And what have you really solved anyway? So why not remain in place, use home equity to structure methodology to care for your financial issues in older age, and use that as a program that will serve a major purpose to fund old age. In fact, the banks, using the reverse mortgage concept, which said that you can convert home equity to monthly income. What do you mean? Well, that means taking home equity and dripping it in your checking account each month. Not all of it, just $700, $500, whatever you need to get on with life. So the banks promoted this with major banners which said, hey, don't pay the bank, let the bank pay you. Well, the bank wasn't actually paying you anything, but the whole concept was you're not making a mortgage payment on it, but you can draw money on the line of credit. So don't pay the bank, let the bank pay you. So while that's an interesting use of the program, with the costs and elements of society that we face now financially, it's usually the line of credit that is most useful. So let me just pause here for a moment. Steve, you have any comments or any questions that might want to address this point?
Okay, there we go. Bill, I did get some questions from Carol before the event started. And I'm just going to read these to you. And if you address them later, great. But Carol asks, on reverse mortgages, do you have to report it on your state or federal income taxes? And then the other thing she asks is, if you're a low-income senior and qualify for the Homestead Act local real estate exemption, will it be counted as income, an asset, or a liability? So if you want to answer that at any point in the discussion. Another one just came in from Blake, who says, are fixed interest reverse mortgages readily available, or are most of them variable?
Yeah.
So the questions are coming in fast and
All right,
furious.
okay. Well, that's good. I mean, just quickly on the question about taxability. No, I mean, no loan is taxable. Loans are liabilities, right? So any type of loan, whether it's a credit card loan or a bank loan or a home equity loan or a reverse mortgage loan, those proceeds are not taxable in any respect with any agency at all.
Okay.
The other part, in fact, I'm going to cover later in the program the issue relating to senior tax waivers, and
Okay.
but just know that, yeah, that's not an issue either. That's a benefit. It's amazing if those people who don't understand that fully, you're going to be amazed. The issue on are fixed rate plans available? Yes, they are, and we'll take a look at that too. But essentially, just understand that in today's market, forget reverse mortgage, regular mortgage, adjustable rates are usually a bit lower than fixed rates, and yet sometimes the higher rate will give you more money and it's worth looking at. So we won't get into that detail, but always available to cover that.
And then one last one that I just want to throw out there so everybody knows that we're getting your questions. This is from Deborah, and she says, bank pays the mortgage payment, but can the owner make withdrawals on the line of credit for house repairs? So.
Oh yeah, well that's the whole, yeah, interesting. Well, that's what we're covering here today. First off, the statement that the bank pays the mortgage payment is not the statement. The fact is, once we go through how you borrow money against the home, you do not, as the borrower, need to pay any mortgage payments. What happens is that the interest is being added to the back end of the loan, okay? Now, you can pay the interest. Some people do, most don't. But in that particular case, yeah, you are simply creating a line of credit, just like a regular bank loan. There is an amount of money that's available to you, and you ask for it whenever you need it, okay?
Okay, great. Well, I'll let you get back on track now.
All right, good, we'll come back in on those. Thanks a lot, everybody. So yeah, there are two primary program choices I want you to be aware of. One is the FHA loan, but we also have a proprietary loan in the industry that is provided through what we call Wall Street investors, right? The FHA program is managed, monitored, and created under HUD, Department of Housing and Urban Development, through FHA. So they say that the maximum loan calculation that they will make to determine how much money a person can get, which we'll touch on the next slides, is $822,375. What does that matter? Well, that means that the home is worth $900,000. You still have to calculate the loan amount that can be made available to you to the maximum FHA limit of 822. On a proprietary side, we have loans available on homes valued up to $4 million. So those are just depending on the circumstances where your reverse mortgage advisor can guide you as to which program can provide the correct attachment to your needs. Okay, and in that, from either program, once we just establish the value that you can get in funds, you can leave that in a line of credit. In some programs, you can pull in all the money at once and then take out a big basket. Or the tenure payments, which says that's the monthly drip. Tenure simply means as long as you live in the home, this money will drip into your checking account each month. So we'll talk about that, because here's the point. How does this work? Well, we take the home value, $500,000 home, for example. The loan balance, well, you owe $200,000 currently. And your age, well, let's say you're 62 or 75, whatever. And depending on your age will determine how much money can be extracted from that home. It looks this way. You see here on this lower left-hand corner that in an age of 65, with a $500,000 home where you owe $200,000, well, we're going to refinance this. Think of it as a cash out refinance, just like any other loan. We're going to pay off your lender $200,000. You still owe it. You just owe it to us, the new lender, but you don't have to make any payments on it. So at age 65, when we do this calculations, we say, well, if you're in your 60s, we're going to let you get this much home equity in a line of credit. If you're 92, we're going to let you get this much, because you're going to die sooner. So obviously, the more life term you have, the less money you'll get to start. But there's some other advantages. In this case, well, we pay off the $200,000, and that leaves $16,000. Not much for a 65-year-old, but keep in mind that person has just eliminated a mortgage payment. Calculate it. What is your monthly mortgage payment? And if you don't have to pay it for 12 months, how is your cash flow improved? As we move into age 75, well, now we can pay off the $200,000, and that leaves $45,000 in a line of credit. Or let's convert that into this monthly drip. It's an annuity-like type of distribution. And we say, well, okay, or would you prefer $260 a month for the rest of your life while you live in that home? Or if you're 85 years old, we can pay off the $200,000. That leaves $91,000 in a line of credit. Or perhaps you'd like $700 and some change for the rest of your life in that home. But look, if the loan balance is zero, if mom has lived in this home, which they bought for $170,000 many years ago, it's now worth $500,000. They paid it off years ago. There's no debt remaining. Well, in that case, all the money, see, $216,000, $245,000, or $291,000 is completely available in this line of credit, such that now you can withdraw that money to pay the cost of elder health care or emergencies or college funds for your children, depending on your own personal situation. So let's stop at this point before I move on to see if there are any other questions. Steve.
There we go. Sorry,
Yeah.
I'm using Kitty's computer. That's why I'm a little bit off my game today.
Now you're going fine. We love you.
So yeah, no other question. Oh, actually, so what if the actuarial tables are not correct? Like, what if somebody ends up living to 105? Do they still can stay in the home, correct?
Yeah, I love that question. Yeah. Well, yeah, we don't have to die according to schedule. So the point is that whatever relationship you have under the terms of the loan will last through the lifetime of the borrower or the borrower's spouse, whoever is on the loan. The last person to pass away closes the scenario, and then the home would need to be sold if it's inherited, now, refinanced, whatever.
As a follow-up to that, what if it's the reverse? What would happen if, like, let's say that there was a tragedy and somebody was basically taking this on a monthly balance, and they pass away 2 years after they do the reverse mortgage? Would there be something that would go to the estate? Like the remaining balance, would that go to the estate?
Well, great. There's two elements to that. Number one, yes, if you were to pass away, let's say you're a sole homeowner and you've got an estate, you have children and grandchildren, and you have borrowed over those 2 years let's say $40,000, $50,000, that is your loan balance. So whatever loan you started off with, plus whatever money you have taken, is now due. In that particular case, then your estate, your children, just like this is no different from a regular mortgage or a reverse mortgage, the home has value and there is debt on it. So in that particular case, the children could refinance the home, pay off the mortgage, keep the home, sell the home, whatever they wish to do. But no, they would not inherit the line of credit. You have to settle at debt.
Okay.
Yeah.
Okay. And then Burke has a question, and it's with no mortgage, why is the available credit less than the home value to allow for future accrued interest?
Well, yeah, I mean, look, the amount of the loan is calculated under the terms of the federal program, right? So let's agree that you must have some equity in the home in order for this to work. Equity meaning what is the amount of free cash over the debt you now have. If you have no debt, then the entire equity is available to, but the government or any other plan doesn't let you take it all. If you want all the equity, then you must sell the house, right? We're just providing an equity loan against the value of the house. Just assume you have to have at least 50% equity in the home to make this work. Okay.
Okay.
Yeah. So if you have a $500,000 home and you owe $375,000, and we can only provide, say, $250,000 or $260,000, there's not enough money that can be extracted from the home to first pay off the existing mortgage. So the amount of funds must first exceed whatever else you owe, because we will refinance that part first.
And you know, I know a little bit, just to be dangerous on this topic, just because I've been, you know, listening to you and others lecture on it over the years, but I've always sort of felt, and feel free to correct me if this is, I've always sort of felt like the reverse mortgage is really ideal for somebody that wants to stay in their own home, that doesn't necessarily have cash and liquid assets, and but they have paid off, or they have a significant amount of equity in their property. Is that an incorrect statement, or is that a good way to think about it?
No. I mean, actually, it's great. First off, you must want to stay in your home. Yeah. Because your option is always, as I said, sell the home and take the cash. Mm-hmm. Right. So of course you can do that. That's the issue then. Right now in our market, you sell the home at the high price, you can't buy the other one anyway because the price is even higher. So why would you want to do that if you want to remain in your locale? So in this case, you simply make a decision to take equity out of the ground by the shovelful. Go out in your yard and start digging up money. That's what it is. It's a cash out refinance. That's what it is.
Here's another question came in. Is your company a reverse mortgage lender? Where are you located? Is your reverse mortgage company a lender that's nationwide? To and for all the states are the community locations that you can provide this?
Well, yeah, thanks. I mean, we'll have the ending panel with all that information. I'm based in Leesburg, Virginia. I'm the founder of Senior Lifestyle Mortgage, which is an independent origination company. We represent different lenders in the nation. I particularly focus on being in Maryland and Virginia, okay? But to the extent that you have friends or relatives and colleagues in Florida or Wisconsin, I have a long reach of colleagues who will serve them. Okay. So just know that the bottom line is that there are many lenders in this segment, but in reality, there's probably 10 who are really own the market on that top segment, and I represent all of those. So be happy to
Great.
talk with anyone about that.
Great. Well, I got through that round of questions. Folks, just keep on typing them in,
Yeah.
and Bill, we'll let you get back to telling us more about this product, and then we'll get some more questions in.
Yeah, great, because now we're going to get into the meat of it. Just want to get this concept in place. And thank you for your questions, everyone. Many of these will be answered, and at the end, we'll cover any loose ends. But essentially, one of the most important and valuable aspects of the reverse mortgage is that you see this term FHA insured. Well, what's that mean? Well, this is remarkable. You're not going to believe this, but in a sense, of course, the FHA insures the fact that whatever money you have available to you in that line of credit, like I spoke earlier to the fact that it can never be canceled or modified, that money is guaranteed under the full faith and credit of the U.S. government, such that if you have $100,000 in that line of credit, no emergency, no conflagration, no destruction other than the systems themselves will take that money away from you, always guaranteed. On the other hand, the lender is guaranteed to receive the proceeds even if the home is underwater. This is so incredible to understand. You have a $500,000 home, you borrowed $200,000, you now owe, years have gone by and the interest has increased on the back end, you now owe $350,000. And your home should be worth $750,000. But as we all know, you now owe $350,000 and your home is now worth $200,000. Underwater. In the reverse mortgage, there's no such thing. The lender, you as a borrower, owing more than you have value in your home, can simply walk away if you wish, or refinance the home at the lower value. And the government gives the lender the delta. You owe $350,000, your home's worth $200,000, you can get the home at $200,000, the feds pay the lender the $150,000 difference. Amazing. There's a cost to that. You've heard about the fees of a reverse mortgage. Look, the FHA requires that every borrower have embedded in the loan a 2% fee based on the value of the home. So in this $500,000 home, they're going to charge at settlement, you're not writing a check, but it's added to the loan, 2% of $500,000 or $10,000. That is the money that every borrower uses to fund the pool of funds available through FHA to compensate lenders and borrowers who go underwater. If your home is ever underwater, you can walk away. There's no credit ding. There's no issue. There's no pain. You just say, here, I don't want the house. It's not worth anything. Or you can refinance it at the lower value. So that's the power of this program. So let's get into some meat here. What are the requirements? Well, here's the thing. You're not making a loan to your bank on a mortgage, your mortgage lender. So there's no escrow payment, right? You're not paying principal, interest, taxes, insurance, and then the bank makes that payment for you. In this case, you've simply taken out a home equity loan, and now it's your responsibility, as many times it always has been anyway, to pay your county real estate taxes yourself on time. Pay your homeowner's insurance premiums, pay any homeowners association fees, and of course, maintain the house. That's not unique. It just means that you can't let the roof fall off and still have a mortgage any different than that would be with Wells Fargo. That's what the borrower has to do after they initiate the loan. But on the other hand, there's certain qualifiers. In the old days, when I say the old days, 7 years ago, you only had to be alive and breathing to get a reverse mortgage loan. Only thing is many people who are alive and breathing got a lot of money out of their houses and lost that money real fast. They never had that much money. So that feds canceled all that and said, we're not going to do that. You have to have certain criteria. It's not a FICO score. We don't say, you got 670, come on in or whatever. No, it's not that. It's based on what your credit history is. Do you have lates? Do you have multiple lates, 60, 90-day lates? Have you shown capacity to be able to maintain your home expenses, right? And what kind of income do you have? Because when you look at the bottom where it says residual income analysis, here in our region, after all expenses, the government is really saying, hey, come on, folks, you've got bills, you've got utilities, you've got real estate taxes and all this to pay. Do you have any money left over so that maybe you can replace a window or fix the steps? So in this case, you must show at least you've got for a party of one, $540 left over after all expenses, and for a couple, two people, 906. It's moderate, right? But it's just simply showing, can you sustain your lifestyle? Above that, property charges, we're wish I could talk. Actually asking if you are paying. We check, are you and have you paid your real estate taxes on time? Are you making those homeowner payments, homeowner association payments? And by the way, everybody, do understand that a homeowners association fee, which you might take lightly, is a lien attachment. If you do not pay your homeowners association fees on time, they can place a lien against your property. It's reported when you're going to do a home loan. Do they pay their fees on time? All those things can really impact you. Reverse mortgage, regular mortgage, just know that. So, but what happens if somebody can't do it? In the old days, we gave it to anyone. Now we say, if you are close to being able to match these requirements and not there, you've had a few lates, maybe you missed your taxes once or twice, we'll still do the loan. But what we'll do is we'll say, now we are going to take responsibility for you. We want you to stay in your house. We're going to give you the loan. But now, because you are X age and your taxes are such an amount and premiums for homeowners insurance, we're going to pull that all back. We're going to rake that out of your money. Let's say you had a $150,000 line of credit. You're 72 years old. We're going to calculate your real estate taxes on an annual basis for maybe 10 or 12 years in advance. Same for a premium, homeowner's insurance. In that case, we're going to rake it back. And that might be $50,000, $60,000 over 10, 12 years. Fine, your fees in this case are always going to be paid for you. Peace of mind. On the other hand, it reduces the total amount of money you have available to you, but it's for a good purpose. So we can let you do the loan. We just have to now step in and take on some of your responsibility with some of your available proceeds in reserve. Okay. All right. Let's take a stop here, Steve. All right. If Steve's not coming on.
No, there you go. There we go. I told you I'm slower on the trigger here. Okay. Well, two really good questions here. Okay. Burke says, except for my mortgage, I have no debt and I have not had any debt for years. Will that be a problem on my credit history? I do pay a condo fee. That's an interesting thing. How do condo fees factor in if somebody wanted a reverse mortgage on a condo?
Yeah, that's what I was just addressing. That's a homeowners association fee, condo fee. So you must pay those.
Okay, but as far as her credit,
are you saying if you have no credit, you always pay cash? Well, that's not a deal closer. I mean, that it just means that you explain why that is, and you show the history of good payments for other items, and you're fine. That's not critical.
Okay, and now this one I love because I know this gentleman. Bernie Cohen says, our reverse mortgage went into effect in November. It's been an absolute pleasure not making any mortgage payments. We have to pay separately for real estate taxes and homeowners insurance,
right,
which for us is about 25% of the yearly mortgage payment. Our line of credit is a handy cushion to have. Besides all of this, our heirs will enjoy the appreciation growth of our home. What's more, if there is another depression and the house falls into deep water, the reverse mortgage funder eats it, even though the appreciation stays with the estate. So
right.
I know Bernie Cohen, and that's great that I was hoping that we would have somebody that has done a reverse mortgage on this call.
Yeah. Yeah, Bernie, you're telling my story, and that's the fact, because we already started off by saying that you've heard these stories, and it's like that's old news. You can't go back 33 years because we talk about things that happened, but that wasn't the program. It's the people, and that's true with roofers, bankers, attorneys, accountants, whatever. The loan itself is a beautiful problem solver in which it's simply a home equity loan, extracting cash, some of it, not all of it. And to Bernie's point, the home will continue to appreciate as always. And quite frankly, the interest rates, which these days are a little bit under 3%, right? 2 7/8, flux. But nevertheless, over time, we would expect that the interest accumulation rise. It's a negative amortization loan. You're not paying it down, you're letting it ride. I don't want to pay it. So in that case, over time, the debt gets larger. Hopefully the home value increases, and you actually never lose any equity value because you've consumed some, but let some ride. If it goes the other way, you're off the hook there too. Anything else?
And let's see, Burke Dillon has, I don't know if Burke is a male or a female, so I can't refer to you, but she has her hand, he or she has her hand risen.
No, I didn't mean to do that. I was just trying to figure out how the buttons worked.
Oh, okay, great. Well, great to hear from you, Burke.
And it's a she.
Oh, it's a she. Okay, all right. So, okay, let me mute Burke, and then let's see. Bernie Cohen says, "Where is my endorsement fee?" Yeah, Bernie. Hey, if I had any money in my pocket, I would give it to you. Mary says, have you talked about the maximum amount for the DC area yet? So is there a maximum amount that a reverse mortgage can provide?
There's no, thank you. There's no, we touched on that. It's a national program. So DC isn't unique. Under the FHA program, the maximum loan calculation is based on $822,350. But again, there are Wall Street proprietary loans that can go as high as $4 million. Some with or without fees. There's all types of variants, but that's basically it.
Okay, and that's okay. That's great. Okay.
Yeah.
All right. Well, I got through those questions. Do you have some more slides to share?
You bet. Let's rush through this. We're at 12:43, and I really want to cover these last few screens. So let me get through that here, and we'll come back together. This is really important because we're going to get into specific examples, real life scenarios, not made up, clients of mine, people who reached out to me, usually through financial advisors and through healthcare professionals who bring me in to resolve the issue. In this particular case, this screen, I don't want to be too cluttered, but just there's a lot of detail here. Martha, age 84. Look just below her name, right? She, and with her family, is paying $14,000 a month in home care round the clock. Well, she has a home valued at $450,000. There's no mortgage. Under the terms of the calculations, which touched on, we could provide $293,000. Remember, it's no existing lien, so we pull $293,000 from the house. I said you could take the money out of the line of credit. True, but we also have a limit on the first year. The feds decided they didn't want anyone to take it all necessarily, so you can take 60% of the funds available to you in the first 12 months, but after that, whether you've taken some or not, it all opens up. Well, that simply means that if the family wanted to take $169,000 out at settlement to pay the $14,000 a month, then that means that if they continue doing that, that they have actually paid the $293,000 over a period of 20 months to get mom into the position of whatever it's going to become. I don't have to tell you. Mom is going to live or mom is not. The income that comes from the house to pay for that can only be through the equity in the home until you might need to move her to another facility. But while she's in the home, you have access to cash and you have access to peace of mind. In this particular stage, after these 20 months, if anything had to change, the home could be sold. And regardless of what the appreciation might be over those 20 months, you can see 450 minus the 293 leaves $166,000, which could then, upon death, go to the estate, to the family, or more based on the equity at that. Okay, so let's take a quick look at on the wealth management side, assets. Think about this. There are cases where people get to a point where they're pulling down money out of their retirement income asset portfolio. Well, you've heard about the 4% rule. Here's Gladys, age 78. I'm brought in by her financial advisor who says, Bill, we've got to resolve this issue. She's pulling down $89,000 a year out of this account, and that's about 12% of the funds available to her. He says she's going to run out of money in 7 years or so, and she's only 78. Now, she lived in $1 million home. She had an existing mortgage of $404,000. So at her age, based on the calculations under the federal program, we calculated against an $822,000 max. We could provide $427,000. Well, okay, so we paid off her $404,000. We refinanced it. She no longer had to make a mortgage payment. But that was the whole key. It wasn't like there was another $100,000 in that case because her mortgage balance, I mean, the value of the home had gone up, but basically she still owed the same amount, right? So in that case, the money that she could generate was the reduction in the out-of-pocket cash flow to make a mortgage payment each month, $2,000 a month, $24,000 a year in fresh new money, which meant that they could reduce the amount of draw coming out of her portfolio and give her another 8, 9, 10 years of money just as a result of doing that. Powerful use of the program. And okay, let's talk about purchasing a home, downsizing in old age. This is really not touched on very much, but you've got to understand the power of this. Hey, the Jacksons, age 70, they want to sell their home and move to that special place on the coast or in the mountains.
Bill,
Yeah.
I don't want to interrupt you, but if you could go back to the slide with Gladys. A question is, will Gladys pay the 2% fee on the $1,550,000 or the $427,000?
It would be the full value, except in this case under FHA. Remember that maximum is 822, so it would be 2% of 822,000.
Okay.
Okay. All right. So moving right along, purchasing a new home. The Jacksons, they have a $500,000 home. What are they going to do? They're going to sell it. They're going to walk away. There's $460,000 in net proceeds after real estate fees and settlement fees and all that. So great. They've got $460,000 in hand. They want to buy that condo in their favorite place. It's a $350,000 condo, and they do the worst possible thing. They just pulled $460,000 out of the ground, and they threw $350,000 back into it, maybe never to be available to them again, which leaves $110,000. Yes, they have a condo without a mortgage payment, but they have only $110,000 to live the rest of their life on, based on whatever that might be relative to others. So why would you do that when there's another option? Well, good reason to do this perhaps, but look at this. Same people, they still don't want a mortgage payment, but they want to keep as much cash as possible on hand. So we do what's called a HECM for purchase loan, a reverse mortgage purchase. And we say, look, same thing, you sell your home, you get $460,000. Yes, the condo is $350,000, but how about we give you a loan for $160,500? You never have to make a mortgage payment. Calculate the $350,000 payment or mortgage if you had one. You pay $189,500. The remaining funds are $270,000 and some change to now live the rest of your life to manage with your financial advisor. But look, the concept is you have bought a $350,000 condo for $189,000 and some change. Well, now you've got money left over to rebuild the decks, add the swimming pool, whatever amenities you might have, new kitchen, whatever that might be. But you now have a $350,000 condo, which may or may not go up in value, and you don't care. You have a $270,000 to put in the hands of your financial advisor to grow into whatever small fortune you can get out of that. And the only thing you have to do is pay your real estate taxes, homeowners insurance, homeowners association fees, and whatever happens in the future, up or down, will take care of itself. Fascinating concept. All right, let's leave with this, and then we'll kind of finish up. We're right on schedule, I hope. Yeah, Homestead Act, senior real estate tax waivers exist in every county. Usually require 65-year-olds or older, right? But here's the key to this. Forget the value of the home. The home can be $1 million home. It can be a $2 million home. It is lifted out of the equation, set aside, and the county says, how much money do you have in your asset portfolio? In Montgomery County, Maryland, they say you can only have net worth of $200,000 or at least $200,000. You cannot be earning through Social Security, pension, or anything else greater than $60,000. In that case, they waive your real estate taxes entirely. Look at Loudoun County. Your net worth cannot exceed $440,000. Your income through Social Security, et cetera, cannot exceed $6,000 a month. And if that's the case, your taxes are completely waived. People don't understand this. They don't hear it. Some do. Some are in the game. The counties love to promote their real estate tax waivers for seniors, but they're not really doing that with a lot of music and horns. They like the income revenue too, right? So be aware, it exists for everybody who can meet these criteria, large county, small county, whatever. So that's important to leave. This is one of the happy times of my life when I step into a family's home and introduce this to them, and they never knew. And they've been paying taxes on mom, for the last 18 years without knowing they could get out of it. Okay, so that's the story. And I hope you've thoroughly enjoyed that. We've gone as deep as we can. There's also a lot more we can say. And I ask that you, call on me if you need additional information. Love to talk to you. No charge. I love to educate. I love to help families. Okay, Steve, back to you.
Okay, well, this is great, Bill. And I'm going to turn my screen on here so you can see. Remember, guys, I'm at the landing at the sales office at the landing in Alexandria. We got another question here, and let's see. It's I'm reading this for the first time. Learned about a senior homeowner born in 1990. She's 102 and wanted to continue to live in her home. She was receiving 24-hour care and assistance with a live-in caregiver. She took out a reverse mortgage using the value of the maximum amount of $822,000, and she received $555,000, which, with good money management, would provide $18,000 and $14,000, $13,000 to $14,000 per month that she could continue to live in her home. Her adult children fully supported her in obtaining the reverse mortgage. Okay, good. As I was reading this, I was sort of like, okay, where is this story going to end? But another good story there, and I'm fairly confident that nobody is paying these people to come in here and, and answer these questions. So,
For sure.
Great story there.
Yeah.
But that's a great example of this being used, and some really good details on the amount of money that is available. Holy cow, we are pretty much wrapping up here, Bill, and I think this format went great where you took some pauses to take questions throughout. Really some great questions out there. What I'll say to you is that it's sort of like, if you want to make sort of some closing statements, and we'll see if any last minute questions creep in. But if not, I just want to remind everybody that we record this, and we'll be able to share that with you so that if you've got friends or loved ones that didn't make it today, they could listen to this and get educated.
Yeah.
But
Yeah, I would
sort of
only
thoughts?
add, Steve, that really the point of all this is that there's opportunity to understand the value for particular situations. There are positive elements related to how the line of credit grows and all this. But just know that while there's things that can be addressed specifically for people's particular issues, just know that whether it's me or someone else you know who's local in the environment, who can step in your door and help you understand the concept, is so much better than calling the call centers. You know, call 1-800, talk to a stranger, pay too much.
Oh yeah. What's the who's the current celebrity endorser? Is it Tom Selleck or?
Yeah, Tom Selleck, yeah.
Oh, okay. But but yeah, no, I totally agree. And especially for those providers out there, you know, what I like about that last audience member that shared that comment and some of the scenarios, this is a great tool for those that are home care providers that are out there, because you may have clients or potential clients that are sort of like, holy cow, how am I going to afford this? And making sure to dive deeper to see if potentially reverse mortgages would be a tool. Okay, I knew this was going to happen. More questions came in. If one does not need the cash today, but wants a quickly available cushion, does it make any sense to think of a reverse mortgage in this context, or is the equity line more appropriate?
Well, it's the same thing. First off, understand that this loan is not for the poor people. You know, it helps people who need money, yes, but also one of the most excellent retirement planning tools that exists in the market. Because if you are 62 and you were to establish a line of credit, you don't need the money, but you just want it there, you want to get the loan, and let's say you get a line of credit for, let's say, $150,000. If you don't touch it, the line of credit grows larger. Won't get into the details, but that line of credit unused at 150 can grow to 250 over 20 years. So it's always there. Remember, it can't be canceled, can't be modified, can't be paused. And that is what we call home value insurance, because once you have the line of credit and that continues to grow, eventually maybe your home could be worth less than your line of credit. Mm-hmm. Call up the lender and say, send me the money. So okay. It's a great thing to do.
Okay. For this question, you probably want to back up, because on your slide deck there, could you explain that last part of it again, about how seniors do not have to pay real estate taxes? Yeah. That was a little bit confusing, but helpful. Thank you very much.
All right. Well, thank you. I didn't mean that to be confusing. It's a remarkable tool that's available by most counties who essentially have a plan in place. Again, not up on a placard on the side of the county building, but most every county in surrounding states and others have a program which says if you will come into or call or contact and go on the web to real estate taxes under your county site, find where it says senior real estate tax waivers and personal property tax waivers, and you will see that in this case where I was pointing out in Loudoun County, you have to fill out the financial forms, but if your assets, excluding the home, doesn't matter, set it aside. If your assets, take your investments, your savings and CDs, whatever you've got, do not exceed $440,000 in Loudoun County, and if your income is not greater than $72,000, then your real estate taxes are waived completely, not deferred, waived.
And yeah, probably the reason why this was a little bit confusing is because we've been talking about reverse mortgages, and then we kind of moved into this little secret
added value.
Now, just out of curiosity on this, if I've got a reverse mortgage, I don't own that home anymore. So,
Time out. I
Okay.
can't believe you said that, Steve. That is one of the most common misconceptions ever.
Okay.
And I'm glad you brought that up. That's why I had to say time out.
okay,
The home it's no different than having a loan with Wells Fargo.
okay.
Of course you
So,
own the
so
home.
we're still, and now I remember. Yep. So that is you're still paying real estate taxes with a reverse mortgage.
Of course.
Okay, got it. Okay. Okay. All right, let's see. Another one just came in. Does the senior have to be a certain age for the real estate waiver? Yes, it's 65 plus, correct?
Correct.
Okay. All right.
Right.
And that looks like we wrap this thing up, and yeah, it's 1 o'clock. So Bill, thank you. I'm gonna have Kitty make one last appearance on screen. Thank you, Kitty, for having me here. I promise next Tuesday when I'm at the Seneca, I'm going to be even more prepared for these remote broadcasts. And but this was a great discussion, and we'll look forward to sharing the recording with everybody and Bill's contact info. And then we'll see you next week at some of our other discussions.
Great. Well, I thoroughly enjoyed it. Love what I do, and so happy to be a part of this wonderful program that you have going, Steve. Thanks.
All right. Thanks so much, Bill. And we'll see everybody